what do you think is the most important challenge facing women when it comes to managing their finances? It might be in the UK or across the globe. Now, I'll come back to your chat or to whatever message we have in the chat as we go on. But in the interest of time, I'll try to build a momentum with today's conversation. And like I was saying earlier about why this topic is very important, one of the reasons is that representation matters. Talking about diversity and having that sense of belonging. Many a times, conversation about money, whether in the home, whether in the news and everywhere, has been dominated by men. Myself inclusive, if you can use that word. But we've come to realize that women also have their own financial journey, and this financial journey can be very unique, can be very complex. So having that understanding that there is a room, there is a place for women to be able to have representation and also to be able to take ownership of their finances becomes very important. And that's why having a session like this can be very important to really empower women to be able to take ownership of their own financial journey. The next one is about the increasing gender pay gap. For example, in the UK, according to the Office for National Statistics, the gender pay gap between a man and a woman in similar role, those are employed full-time, is about 7%. And what that means is that for every £1 that a man earns, for example, in the same job, a woman will be earning 93 pence. So it means that generally the women earn less than men, when it comes to the income for those that are employed fully. Now, this does not just impact the income, it also impacts how much a woman will have in her pension. It also impacts how much she will be entitled to, even when it comes to certain benefits. So all these things come together to begin to impact the financial state or status of a woman in the society. And if you think about it, when it comes to caring for loved ones, children, and so on, women tend to take the time out of work to be able to look after newborn children or even extended family that are sick. And because of that, it also means that most of the women will have lower income, and having lower income means that they have little or not much to invest. And put that together, it's like a triple, double whammy, as you might call it. So that goes a long way to impact a woman's financial capacity down the line. And so having this webinar will help even to understand what can be done differently, what can be done, to ensure that these gaps can be bridged one way or the other. So the goal of today's webinar is not to help you to become a day trader or to become an expert when it comes to personal finance overnight. No, the essence of today's webinar is just to open up a little bit more the world of finance, especially for those that are beginners that don't have much to experience with personal finance. And hopefully with the conversation, you can build your confidence. And once you build your confidence, then you can then begin to make informed financial decisions about your own money, where your money goes, and what to do with your money. So the first thing I want to start with for tonight's discussion, I have divided it into 4 different sessions. So the first part is about the foundation. And for this foundation, I want to talk about your money mindset. So here, money mindset as it is, it's just a term that we have used, to describe the complex relationship between your belief, your attitude, and your emotions as an individual towards money as well as financial well-being. So when we say mindset, is the relationship, very complex one to say, between what your personal beliefs are, what your attitude towards money and your emotions when it comes to money, and how that then impacts your relationship with money. And over time, I've discovered that there are certain beliefs that shape one's mindset when it comes to money. The first one is the family background. And I think this is very important in the sense that if you come from a family where it appears that money is tight, so there is no money, that's what you hear. So if you're not careful, as you grow, as you come into becoming your own independent person, you will also go with that mindset of thinking, oh, money is tight, And if the fact that there is not enough money has caused, fight or conflict between your own parents, then you can begin to see money as a source of stress or conflict between people. And that begins to shape how you approach money, how you talk about money. Or if you grow up in a home where maybe your dad, for example, as the breadwinner, usually hides money, if we can use that word. And what that means is when you grow up, you can also become very secretive when it comes to money. Or if you eventually get married, you can believe that all men hide money. So because of that, when it comes to conversation about money, you will then struggle to really engage in those type of conversation. Now, the other one is cultural, expectation. There's a cultural expectation for many people from African origin, for example, that the man is the breadwinner, and in that sense, it means that the man manages the finance of the home. Now, while in certain scenario that can be very true, it is also true to note that not every man, even though they might earn more in some cases, are very good with managing money. So it means that for every relationship, everyone needs to check who is better with money and let that person take ownership of managing the money, rather than saying, okay, well, I need to, have you, man is the breadwinner, man is the head of the home, as some people will say, okay, you manage the entire money, even though they are not prudent when it comes to managing money. Then the other one is, personal experience. So for example, if you have been betrayed when it comes to money, or someone has hurt your feelings when it comes to money, then you can then begin to work with that when it comes to relating with money. You can become very secretive, like I mentioned. You can then begin to, sometimes even some people choose to spend money as a way of distressing when they are going through a challenging situation. And that's another thing that can impact your money mindset as an individual. Now, the last one that we'll talk about is the faith perspective. Now, what does the faith perspective really mean? It means that for some people, if you grow up, for example, in a Christian faith, well, many a times you've been taught that, okay, you need to give generosity, donate some of your money and income to charities, to the less privileged, and so on. So those kind of belief and mindset beliefs begin to shape your mindset when it comes to how you use money. And so understanding your mindset with money goes a long way to deal with, to determine how well you do when it comes to savings, when it comes to investing, and when it comes to building that generational wealth that we are talking about. And like someone said, doing well with money has little to do with how smart you are or how much money you really earn. It has a lot to do with how you behave with money. So when you get money, how do you behave with it? How does money shape your attitude? How does money shape your disposition towards life, towards other people? So again, that becomes a very strong foundation. So and from my research, there are basically 3 types of money mindset. The first one is the spend it all mindset. So this one is where you get some money and all you think about is how you can spend that money, use it all, and you always say there is more where this comes from, so more will come later. So such people spend all the money that they have, and that is a kind of money mindset. The other type of money mindset is a category of people where, when it comes to money, they are very indifferent. So for them, it's like, well, it doesn't matter. They do nothing with the money. They tend to play it safe. When it comes to investing, they just shy away from it. When it comes to saving, they shy away from it. They just want to see what they see, and that is it. Then there is a last one where it comes to growth mindset. And this is where when you come into a certain amount of money, you are thinking, how can you increase this money? It can be by investing, by saving, or by being entrepreneurial. So you have a particular amount of money, you are thinking, okay, is that something you can buy and sell to increase the value of this money? That is a growth mindset. And, irrespective of the kind of mindset that you have, it is very important that for you to do well with money, you need to first of all understand where you are, and that can then help you to grow into a different type of mindset. And the mindset we are talking about is a growth mindset, where you want to make sure that whatever comes to your hand is improved, is increased, and it gets better. And with that kind of mindset, every other discussion that we'll be having today can become much more, effective, can be much more practicable, can be much more beneficial to everyone on this call tonight. So let's go quickly to the second part of tonight's conversation. And in this second part, I want to basically focus on, saving. Because again, like the topic says, we are looking at saving, we're looking at investing, and we are looking at building generational wealth. So if you consider a house, for many people, those who might know me, I'm a civil engineer by training. So, when we talk about a house, we know there is a foundation, there is a frame, and then there is the roof. So essentially, when we talk about the foundation, that's your money mindset. The frame of that house is your savings habit. So the frame of your financial good future is your savings habit. And now, what does that mean? It means that when it comes to savings habit, we are looking at things like you're building a savings goal, paying yourself first, and also having a financial safety net. And I will try to explain this one after the other as we go on. So let's look at, when it comes to saving. Now, saving should not just be about what you put into a bank account at the end of the month. Basically, after you have spent all your money, whatever is left is what you put into saving. No, that's not how it should be. In fact, you should be able to flip it on the head and say, okay, when it comes to saving, you want to pay yourself first. That is, you first and foremost decide how much you want to save, put that money aside into your savings. Then whatever is left is what you then spend on your expenditure for the month. So in that way, you don't get to the end of the month and you think, oh, you haven't saved this month because you have spent so much. But if you have saved first and foremost, it means that whatever is left is what you spend. And in that case, there is a pot of money that you are building up gradually and slowly for the sake of the future. So essentially, the idea here is whenever you get your salary at the end of the month, you should make sure you have an automatic transfer system that transfers the money from your current account into your savings account. Now, this doesn't have to be a very large amount of money. Basically, it might just be as little as £50, as little as £25, or £100. The idea here is as you become better, as you improve your income, you can also increase how much you put into your savings. And so paying yourself first here means that you save before you start spending. Now, the other way is, now after you have saved, for example, you choose to save a portion of your income, then you need to check the money that is left. How do you ensure that it covers your bill without you necessarily going into debt? And this is where the idea of budgeting comes in. Budgeting, someone said, is you telling your money where it should go rather than wondering where your money has gone. So essentially, at the beginning of the month, you can say, now I have 100% income. So for some people, you can choose to use what we call the 50, 30, and 20 rule. So the idea here is 50% of your income or your take-home pay goes to meet your needs, and the needs here can be, your utility bill, your food, your transport, and then the 30% also goes to meet your wants. Now, in terms of wants, this is generally described as things you enjoy or things you like, but they are not essential for your survival. So essentially, what that means is you want Netflix, for example, because you want to watch some very good movie, but then it's not necessary for your survival. So it means that if you do not watch Netflix for a month, you won't die, basically. So those things can be considered as wants. In some cases, eating out, for example, can be considered as wants. And in that case, you consider that this is not essential to where we want to get to. So it means that those things can be do away with in order for you to balance your budget. Then the last 20% can then go towards savings and debt repayment. Now, I appreciate that some people might have a certain amount of debt that they need to pay. So in this case, you want to ensure that 20% of your income is going towards clearing your debt, And as part of that, you can also make sure that certain amount is going to was your savings. So for this, it depends on you as an individual. You can decide to say, okay, you want to tweak the formula a little bit and use 30% of your income towards savings and debt repayment, the remaining 20% on your wants, and the 50% on your needs. You can tweak it a little bit, but the idea is within 100% of your income, you are able to capture whatever you need to do with money, whether investing, whether saving, whether paying your bills, paying your rent, eating good food, and so on. You want to capture that within that monthly budget. And here you don't need to complicate it. You can simply use a sheet of paper. And for many of us, if you use some modern banks like Monzo or Revolut, for example, they have a budgeting system within those accounts. So you can try to take advantage of them such that you see where your money is going. And sometimes people have direct debit standing order for months that they forgot about. And in that case, you need to go back and begin to check, do you still use this service? Is this something you can cancel? And by putting that exercise in place, it can really help you, to start getting better when it comes to your finances. Now, the other point here is about, life, building a safety net. For many instances, things happen in life, the emergency happens. But some people, when emergency happens, there's no fallback plan, there's no money anywhere. And in that case, they have to go about borrowing, asking friends for money. And that can really begin to strain the relationship between friends. Or they go ahead to start taking high interest rate loan in order to be able to meet that financial obligation. And before you know it, it becomes a habit, it becomes a trend. And, down the line, challenges everywhere. So because an individual then becomes soaked in debt, and then that begins to impact their mental health. So again, what you can do basically is to put aside a certain amount of money. For most people, you can start with £1,000 in a bank account, for example, where you can easily access it, such that if anything happens, maybe you are driving, your tire burst, for example, or something happened that you need to fix your car, rather than going into debt, you can use that emergency money emergency fund to take care of that. And by so doing, you won't have to go into debt, and your financial well-being will improve because you're not fidgeting, you're not running a tasketa and finding where you can get money to fix or pay for that bill. So having an emergency fund is a safety net. So what can you use your emergency fund for? For example, some people have medical expenses that are not covered by the NHS, or the NHS is taking too long. Then you can use such an emergency fund to cover that. Or in the case that someone has lost their job, so in that case, your emergency fund can be a lifeline that you can call upon. Now, again, you remember earlier when I said save for a start £1,000. Now, some school of thought will tell you to go beyond that, maybe have about 3 to 6 months of expenses saved somewhere, such that if you do need the money and you are trying to get a job and nothing is coming for the next 3 months, then you have certain amount of money that can cover your bills, and still, like you are paying yourself from that emergency fund on a monthly basis, even though you don't have a job. And once you get a job, you can start building it over again. So again, think about that. Can you put a certain amount of money somewhere such that if something do happen, you have something, if something go wrong, you have a pot of money that you can fall back home on. Now, there are instances of people who have to travel. For example, if you're an immigrant, you have family all over the world, and then something happens, you need to travel overseas. Rather than being stuck, trying to look for money, you have something, a pot of money that you can fall back on and say, okay, I can use part of this money to pay for my flight, and then do whatever you want to do in your home country, come back and continue building it up again. So these are some of the things you can use your emergency fund for. So basically, having that safety net is very important. Now, the next thing we'll talk about in terms of smart saving is that you should have a savings goal. Like certain sayings says that if you don't have a destination in mind, everywhere becomes a direction, basically. So if you have a savings goal, what that means is you put the money towards an itemized goal. And in that case, you can work towards it faster because you know what you are saving towards. But if you are saving money without a goal, for example, you are not saving towards buying a house, you're not saving buying towards buying a car or paying for your school fees, for example, or children's school fees, then even putting money aside becomes very difficult because there's no motivation. So when you want to start saving money, have a goal, put your savings towards a goal, and before you know it, it begins to increase. And as you approach your goal, whether you want to save £1,000 towards a down payment or £10,000 towards a deposit for a house, as you get closer to that, in fact, yourself, you'll be much more happy because, again, it appears that your life is making progress without necessarily stressing yourself further. So I think it's very important to have a goal, and by so doing, you can do better when it comes to money. Okay, so again, if you have any comments or questions, do post that in the chat, and then I'll get back to that. And so earlier on, I asked us to tell us what are some of the challenges that women typically encounter when it comes to managing money in the UK. I'm trying to look out for the chart now and see what we have there. So just bear with me for a second. Okay, I think for some reason the chart is hidden somewhere. So once it come up, I will try to find it and share some of the comments. But if you find it, please check the.
All right. So would you like me to read it out?
Okay, please go ahead.
That doesn't match one's finances. Another person said knowing how, what, and when to invest. And then someone else said mindset.
Okay. I think at the moment we've mentioned or talked about maybe one or two of these things, like mindset, we've mentioned it. And also, the other one is the flamboyant lifestyle, which again, we call it lifestyle creep. That is, the more money you make, the more money you spend. And I think it's a natural tendency that when you make more money, your taste begins to change. For example, at some point, you might like shopping in Aldi, for example, and then after some time, you start making more money and it becomes like a stress to shop in Aldi, and you want to go to Waitrose, for example, just to, flaunt it, for example. There are things that we do that we now begin, we begin to match up with a different expectation. And in terms of the flamboyant lifestyle, the other thing is when you begin to compare yourself with other people. We call it keeping up with the Joneses. That is, you see your neighbor, your friends, or people around you, they're driving the latest car, but your own car is 10 years old, and you begin to feel a little bit inferior because your friend is driving the latest model. But don't forget, your friend might have a finance that they are paying at the end of the month, but you don't have a car finance because you bought your car outright. So it means that your friend is probably worried that if anything happens with their job, they're not able to pay that, they might lose the car, but you can sleep well at night. So again, there must be a balance, in the sense that you see it, okay, yeah, it's all that you see is not all that it is. And as we begin to talk about wealth, I would really emphasize that anything that you see that you might want to use in saying someone is wealthy, that is in some sense what we call someone being rich. Being rich is different from being wealthy. Many a times wealth is intrinsic, it's not seen. When you look at it, it's not really seen. But whatever you see, it means it's a realized wealth. It's a wealth that has been spent, and that's why you can see it. For example, if I drive a £50,000 car, for example, in that case, it means that I don't have a £50,000 in my bank account for that, because again, I've used that money to buy that car. So that car that you see is a realized wealth, but somebody else might have £100,000 in a savings account or in an investment account. But if you look at them, you think that they have nothing. But for such a person, those are the people that are really wealthy, because when opportunity comes to buy a business, they have liquid cash to be able to buy a business. But for some other people, they don't have, they don't have the money anywhere. They have a 50,000 car, £50,000 car, but when it comes to time to buy a business worth 40,000, they can't because there's no money anywhere. But you see someone doesn't look flamboyant, doesn't look as though they have money, but when an opportunity comes to buy a business for £50,000, because they have £100,000 in the bank account, they can easily make that decision. And that business that they bought for 50,000 can easily become a 200,000 business, but a £50,000 car can never become another £50,000 car, another 200,000 pounds car. Most times the value will depreciate. So whatever you are spending your money on, begin to check, is this value added or value diminished? And I think those are very important points. When it comes to investing, I think that's the next thing we'll be discussing about investing. Essentially, what we want to talking about here is compound interest, and compound interest, like Albert Einstein said, is like the eighth wonder of the world. Essentially, this is where your investment or the return of your investment starts earning a return of its own. So if you invest £100 and £100 becomes £101, and you keep that money invested, it means that you're not just investing £100, you are investing £101. And then whatever return you get will be on 101 and rather than 100, which is your starting point. So that is one of the power of compounding. And if you look at the graph that you can see on the screen, it means that, for example, if someone invests £5,000 annually, every year they're investing £5,000 pounds, and you assume a growth rate of, say 5%, it means that after 40 years, for example, that person will be having around £639,000 in their investment account. Now, on this chart, there are two lines there. If someone else starts investing at age 35, that's 10 years after the person who started investing at 25, and they invest the same amount, the same growth rate, after 30 years, for example, this person will have £354,000. And you can see the significant difference that a 10 years will make. And that 10 years is as a result of compounding. So essentially, when it comes to compound interest, the earlier you start, the better. And I think when we look at it from a woman point of view, it means that as you invest, you have to start as early as possible. And if you have not started early enough, what you can do is to invest more such that you can then begin to, have more initial investment. And because you have more initial investment, it means that you have more foot in, and that foot in can then give more returns over time. So essentially, if you're starting very late, then you might need to do more compared to someone who started early in order to get a ample investment in by the time you are ready to retire, for example. So the other concept that we'll talk about is risk tolerance. And risk tolerance is that ability of an investor, or the willingness of an investor to lose some or all of their investment in return for greater returns. And what does this mean? It means whenever you want to start investing, or whatever you're investing in, when it comes to investment, you must be willing to lose some in order for you to gain more. So there is a level of risk involved, and your risk tolerance determines what you invest in. So for example, on the next slide, you will see a chart which shows you, the different type of investment flavor, in the sense that if you are a very conservative investor, it means that your annual return in terms of percentage will be lower, but then the level of risk is also lower. In this case, we are qualifying risk as volatility. So it means that if someone is very aggressive when it comes to their investing, it means that they can get higher returns, but they are taking a higher risk, and it means that they can lose more. So essentially, there is a risk level to understand when it comes to investing. Now, before we continue, I just want to ask us a question. Maybe we can do that in the chat as well. So what would you do if your investment portfolio were to go down by 20%. So for example, you invested £1,000 and then after maybe 6 months or 1 year, it went down to 20%. So what would you do? Would you sell everything? Would you do nothing, or would you buy more? So what will you do? If you can, tell us in the chat, that would be great. And at least that will get us a little bit more involved in the discussion. So please post in the chat, if your investment were to go down by 20%, what would you do? Will you buy more? Will you do nothing, or will you sell everything? Okay, someone is saying withdraw. So that is take out everything. Okay, thanks. I can see the chat now. Okay, someone is saying buy more. Okay, someone said do nothing for a while to see if it goes up or down. Okay, someone says buy more because there is possibility of it to go up, and then another person says leave it for a while. Okay, so let me ask us a question for every one of us on the chat. Maybe that will help us to understand a little bit of context. If you normally buy frozen pizza from Tesco every week and you have a freezer space to store it, now if you buy this for £3 every week and then you go back to Tesco today and they are selling each one for £1, all things being equal, expiry date okay and everything, would you buy one or will you buy 3? Okay, someone says we'll buy like 20. Okay, yes, so more than 3 exactly. Someone will say I will buy plenty. Now you can begin to see the correlation between investing and your habit when it comes to shopping. For example, when there is a downtime and investment goes down, for many savvy investors, what they will do is to buy more because they are buying at a discount. Think about it as a unit rate. If 1 unit of Tesla is £1,000, for example, for just an example, and you are interested in investing in Tesla, now you bought 1 unit yesterday. Today, that 1 unit is now being sold for £500. Now, would you sell your own that you bought for 1,000, or you will buy another 1 unit for 500, knowing fully well that in the future, the one you bought for 1,000 that is now 500 can still go back to 2,000. The one you bought for 500 can still go up to 2,000. So essentially, when it comes to investing, don't think about the value of the overall investment. Begin to think of it as how many units you have. And the number of units you have, all things being equal, determines how much you have at the end of the day based on the law of compounding. Now, I'll try and do more in explaining this concept as we go on. But again, for a start, it can be a little bit tricky, but use the idea of discount and see how well we can put that into context. So thank you. Can we go back to screen sharing for the slide? Now, for many of us that have answered our question in terms of what would you do, if you scan the QR code on your screen, it should take you to a risk tool. And this tool should ask you maybe a few questions, maybe not more than 5 questions. And when you answer those questions, it tells you where you fit in. Are you an aggressive investor? Are you a conservative investor? Or are you a low-risk investor? And once you have an idea, it begins to tell you what are the things you can consider investing in without taking too much risk. And of course, as you get better, as you get more confidence, you can then begin to be more adventurous as your confidence level increase. So talking about risk tolerance overall, there are basically 3 levels. We can summarize into 3 levels. One is the low risk, medium risk, and high risk. So if you are investing, for example, in government bonds, corporate bonds, those are low risk because usually they are safe. But if you are investing in ETFs or buying stocks, they can be considered as, when you are buying mutual fund, that is a basket of different funds, it can be considered as medium risk. But if you're buying individual company stock, that can be considered as high risk in a way, because if a company fails because they went into administration or they collapse, then it means that all your investment is also gone with that company. But if you have a different type of risk investment where you have your money spread in different companies, then that way you have something even if one of those companies collapse. And I think that leads us nicely to the next point that I want to discuss, which is diversification. You might have heard the saying that says, don't put all your egg in one basket. And what that means is you need to diversify. So it means that when you want to start investing, or when you are investing, begin to think about it. Do you need a little bit of stock? Do you need a little bit of bonds? Do you need a little bit of cash? Or you want to invest in property, depending, so that you can balance the risk. In some cases, if you invest in stock, the stock market goes up and down, then you can balance that risk by having some cash or some investment in government bonds or even in property. So it means that even when there is economic downturn, people still need a place to live. So there will be people that will still want to pay rent because they needed a place to live. So you can mismatch your investment such that you're not taking too much risk if anything should happen in that line of your investment. Then the other way of looking at diversification is to invest across the world. So essentially, you are in the UK, but you don't just invest in the UK. You want to buy shares of companies or funds that are for companies in the US, in Australia, in Canada, in China, in Japan, in South Africa, and so on. So in such a way, if the economy is not going right, for example, in the US, then you know that such times, usually emerging markets like China, South Africa, they can do better. And in that way, your investment is being supported by the earnings or the income or the growth from the emerging markets. So again, spreading your investment across the world can have its own benefit, in the sense that if something is not right in an economy, then you can balance that within your portfolio. But then if everything is going all right across the world, then you are in a good shape because a lot of things are working in your favor. So now, in terms of investing in the UK, there are different ways of investing. One of it is what we call the stock and shares ISA. Now, the stock and shares ISA is a tax advantage investment account, in the sense that whatever growth you have within that stock and shares ISA is not going to be taxed by the government. So if you invest £1,000 and your £1,000 becomes £2,000, that is, it has doubled in value, basically 100% increase. If you decide to take out that money, then the government will not tax you, because you are investing in a stock and shares ISA, which is a tax advantage account. Now, the other way is to invest in what we call your pension. Now, for as many of us that are here and you have a job, or you are self-employed, then the encouragement to you is to have a pension. Now, pension is very interesting in the sense that when you are investing into your pension, the money that goes in typically goes in tax-free. And what that means is, if you put £80 in your pension account, and if you are a basic rate taxpayer, that is, you're not paying more than 20% on your income, then you get tax relief on that. So £80 that you put in can easily become £100 because of the tax relief from the government as a basic rate taxpayer. Now, if you are employed, your employer usually will also give you additional amounts into your pay additional amount into your pension. This can be 4%, 8%, and in some places you can get as much as 20%. Now, there are instances of people opting out of their pension because they felt like they need the money now. But the reality of it is, if you opt out of your pension, whatever amount of money your employer wants to give you or pay into your pension, they won't give you as a cash in your hand. So basically, you are losing out on future money because you have you have chosen not to pay into your pension now. And the interesting thing is, if you pay £80 to your pension, like I said, your employer can pay additional £40 into it. Government will give you another top up. So essentially, you will end up having more money in your pension than if you decide to take that money to spend on yourself. So again, as we go on, begin to think about it. How can you take advantage of these two options to be able to improve your financial outlook? So I've mentioned this briefly, but I want to go through it a little bit further. That is, what are the things you can invest in? Now, there's what we call equities. Equities are stocks or shares in a company, and it means that you have a part of that company. So because you have a part of the company, it means that as the value of the company goes up, your investment goes up. And at the same time, this company can also decide to reward their shareholders in the form of a dividend. And so they pay you dividend as a result of you being a shareholder in that company. So for example, if you shop in Tesco and you like Tesco a lot, you can decide to buy Tesco shares. It means that as Tesco make more profit, they will distribute part of the profit to you as dividend. But because Tesco is doing very well, it also means that more people are buying Tesco shares. And as more people buy Tesco shares, it also means that the value of the share begins to increase, because the higher the demand, the higher the price. So in that case, if you invest £5 in Tesco in 2020, perhaps by today, that £5 with dividend reinvested and dividend pay, that £5 might be worth £7, for example. It means that over the course of 5 years, you now have additional £2 on your £5 that you have invested. So it means that your money has actually gone up by almost 25% in that case. So you can see the aspect of investing in companies as a kind of investment vehicle. Now, the other one is bonds, and bonds can be said to be government debt or company debt. So essentially, the government needs to borrow money in order for them to invest or pay salary, whatever they need the money for. Now, if the government choose to borrow this money, the way they do it is by issuing what they call bonds. And this bond is a form of debt. So if you buy the bond, it means that the government is assuring you that this bond that you have purchased, after a certain amount of time, we will give you back the money that you use in buying this bond. But between now and then, we'll be paying you interest on the money you have used to buy the bond. So if you buy a 10 years bond, for example, it means for £1,000 and you have a rate of 5%, it means every year the government pays you the rate of maybe say 5% on your investment every year. But then after 10 years, you get your £1,000 back. So it's a little bit very safe investment, because you know that most governments will not default. And as they will not default, it means that you get your money back at the end of the term of the bond, and at the same time, you get some interest. Now, some people might choose to invest in real estate. That is, you buy a house, for example, rent it out, and your tenant pay you rent. And at the same time, the value of the house begins to appreciate over time. So the house that you bought in 2020 for £150,000, by 2025 or 2030 might be worth £200,000. So it means within 10 years, the value of this house has gone up by £50,000. So in that way, it means that your £150,000 has result into £200,000. But at the same time, you also have you also have tenants paying you certain amount of money as rent, which is income, and that is the same. Your investment is giving you income, and at the same time, the value of investment is going up. Now, in some cases, some people might choose to also invest in other assets. For example, they can choose to buy gold. Some people will choose to buy cryptocurrency. Some people will buy art. Some people will buy luxury watches or even cars as an investment. So there are different ways to go about this. But if you just go to the next one, you can see over the long run from this chart, equities tend to outperform bonds and cash. So it means that if you invest your money in equity over the long run, it tends to outperform. The money tends to grow faster when you invest in equity or bond or equity, for example, shares of a company, or even in buying a basket of shares, which we call funds, for example. Okay, so the next one is, how should you invest? Now, when you are just starting with investing, it can look very complicated. And in fact, some of the things I've been saying might look like, oh, it's a magic. How does it work? Now, this chart can help you to understand how it works. First and foremost, you need to decide, what do you want to invest in? That becomes your investment, which is the chart, the small cycle that you can see. And here you can choose to invest in shares, in what we call investment trust, ETF, index fund, and so on. There are different types of investment that you can choose to have. Now, this investment can be within a wrapper. Now, the wrapper can be an ISA, which is your tax advantage investment account. Then you can also invest in a pension, that is your workplace pension, or what we call the self-invested pension. Or you can choose to invest in a general account, which I call the GIA, which is not tax advantage. So any profit from that will usually be taxed by the government. And this wrapper will generally be domiciled within a platform. Now, this platform, there are many of them in the UK. We have, for example, Vanguard, Fidelity, Trading 212, for example. So the idea here is, for example, you want to invest in what we call the ETF, exchange traded fund, that invests across the world, that has shares of company all around the world. You choose one or two investments, depending on the ETF. Then you can choose to invest that money in an ISA, where you can pay 20,000 in maximum in a tax year. Now, once you choose the investments you want, you check which wrapper is best for you. Is it within a pension or within an ISA? You choose one of those two. Then you now have to decide which platform you want that to be. Now, in some cases, the investment you have chosen might not be on the platform that you want or you like. So it means that you have to change something. It's that you change the platform to keep the type of investment you want, or you change the type of investment that you want that to equivalent or something similar that is available on your platform. Now, most of this platform charges platform fee. For example, if you can go back one more for me to say this last point. Most of this platform charges platform fee, but there are some that do not charge platform fee. For example, Trading 212 and Free Trade do not charge you to use the platform. And what that means is you can invest tax-free within this platform. So it means that you are investing tax-free. It also means that there is minimal charges on your investment. So the lower the charges, it means you have more of your money is being invested, more of your money is growing. So whenever you want to choose an investment, try to minimize the charges and find a platform that also do not charge a lot. So these are some of the things you need to bear in mind. And if anyone have any specific question, then I can answer in the chat during the Q&A session. All right, so if we can go to the next slide, and this is where we talk about how to maximize your investment. For number one, use tax-free scheme, for example, like in your ISA or your pension. Very important in the sense that whatever income, whatever growth you have remains within that tax-free scheme. And it means when you take the money out, the government will not ask you for a share of your investment return. Then if you choose to invest in a if you choose to invest in a platform, for example, make sure that whatever dividend is being paid to you is reinvested, because reinvesting dividend simply means that is where you can take advantage of compounding, because it means the return on your investment will now start earning a return. And I have a chart somewhere that also shows you that if you do this, you can get your growth, the growth of your investment can be faster and higher than if you choose not to invest the dividend. Now, the next point is avoid the pressure to make it quickly. And this is very interesting. There are many times that people tell you, oh, if you invest in this, you can quickly get your £50 can quickly become £2,000. Now, many a times people have made mistake and they've invested in such and they discover that it's a scam. So if it sounds too good to be true, it probably not true. So avoid the pressure. Investing takes a long time, so be sure that you have the money you are investing is one that you want to remain in that place for a very long time. So in that way, you are not under pressure to take it out, and by so doing, you can either lose money as a result of investment going up and down, or whatever you are being pressured into investing in might actually be a scam and you end up losing money. So whatever it is that comes with a lot of pressure, you need to make a decision now, and so on and so forth, can be very dangerous. So you need to be very mindful of this. So the last point here is do not invest what you do not have. Now, still similar to the previous point, I've seen instances of people who, because someone told them that if you invest 1,000 in 2 weeks' time, we give you £2,000. So now they went to meet their friends, they borrow money so that if they invest £4,000, they can get £8,000, and then they can return the 4,000 and pocket the remaining one. Again, many people have lost money and they are now in debt, paying back money that they have not spent on themselves because they want to make it quick. So again, investment takes time. So be willing to spend the time, or to give it time. Like I said, investment is like planting an apple tree. You don't plant an apple tree today and go back there tomorrow to expect a fruit. It takes time. It grows into a tree, and before you can start eating the fruit. So that is the idea I would want us to have at the back of our mind. Okay. Again, if you have any question, post in the chat. I'll come back to them as we go. I think the very last part, the fourth part that I would want to talk about is building generational wealth. And again, this is the last part of the topic, and which I think is a very important one. It's a long-term horizon. And what does this mean? It simply means, generational wealth as it is goes beyond financial assets. It means that you are able to pass down not just the assets, not just the money, you are passing down knowledge, values, and opportunity to your future generation. So essentially, the idea here is as you grow, as you get better financially, don't just use it for yourself. Begin to find a way to communicate the same to your children, such that your children are not starting from where you started from. Rather, they are building on your own foundation. So for many of us, probably before now, you know nothing about personal finance, but now that you know a little, begin to share that with your children such that they also begin to build that knowledge, and by the time they are ready to start investing, they are already in a place where they are confident and they can do the right thing. Okay. Now, I remember in part of our webinar on a Keep Steward, I was talking about the ISA millionaire, the first person in the UK to use an ISA to become a millionaire. And he was being interviewed in a podcast, and he was sharing how he did it. And he said his grandchildren, who are about 5 and 7 years old, they are already picking stocks to invest in within their own junior ISA. And again, that's very encouraging in the sense that is like the Bible says, for many of us, some of us that are Christian, a good man leaves an inheritance for his children's children. So for him, even if he chooses to spend all his money, the knowledge that he has passed on to his children's children will lead to better outcome for the generations to come. So as you gain more knowledge, more insight, begin to find a way to pass this on to the next generation, your children's children. So, to do this, it requires a bit of planning, a bit of foresight. And as we have learned about investing and savings, it's important to start as early as possible. So because if you start early, then compounding effect can really help your investment to do better down the line. So in the UK, there are certain pillars to generational wealth. And research shows that 10% of the wealthiest people in the whole of the UK, they hold half of the entire wealth in the UK. So you have 10% owning 50% of the entire wealth of a country. 10% of people own 50% of the wealth in the country. Now in the UK, we have about how many million people? Think about that. 10% of the, is it 63 million people now? Or 6.3 million, I've forgotten the number. But think about the number of people in millions, and 10% of those people own 50% of the wealth. So it means the remaining 50%, or the remaining 90% of people need to share the remaining 50%. And most of these people own their wealth in private pension and in property. And on the next chart that you will see here, you can see that there are different household income level. But if you look at the top 1% on the top of this chart, and if you keep pressing the next down button, you can see that we have different category until we get to the top 1%. Now, the top 1%, they have physical wealth of about 267,000, but their property wealth is about 1.3 million pounds, and their pension wealth is about 2 million pounds, for example. But again, if you look at that, bring it down, and you look at the lowest percentile, most times they don't even have a net worth of zero. Physical wealth, maybe gold or a car worth 8,000 pounds, no property, and no private pension. And as you can see, this is the trend such that those that are really doing well are those that have private pension and those that have property. Now, property is very interesting because if you go to the next chart, you can see that property value appreciates over time. Now, I've just taken an example from a right move of certain properties from 2020 that was sold in 2023. And you can see, for example, the first property, when it was bought for 83,000 pounds in 2001. The person sold it in 2010, that's about 9 years, for 160,000. That's almost double the value. The person who bought it in 2010 now sold it in 2023, that is after another 13 years, for 242,000. So you can see, just by having a house, living in that house for a period of time, which everyone needs a place to live, but just by saying they have the house, before you know it, the value of the house appreciates because people want to buy houses and the supply is limited, the price goes up. And the same thing is true for the other two examples that I have given here. So you can see why people have wealth in property, because again, in that case, they didn't really have to do much because they bought a house in 2020 for 150,000 pounds. In 2025, in 5 years, that house is worth 250,000 pounds. So if they sold the house, or they sell the house today for 250,000, it means they have made a profit of 100,000 pounds over 5 years without lifting a hand. And that's why you can see the top 1% or 10%, they have wealth stored in property. So what does this say? For many of us, the only way, or one of the best way to really build generational wealth is to look into owning your own house. And when you own your own house, then you can then begin to think of owning other properties as well. Now, if you think about it, in terms of home ownership, Black African, Black Caribbean, and Black British are part of the fewest people who own houses in the UK. And again, it's just very sad in the sense that many people from our background, do not know have the income, for example, to own a house or to buy a house on mortgage, or some have made financial decisions like missing payment that then impacts them such that even though they are earning good salary, they cannot buy a house because they have a very bad credit rating. So again, all these things come together to impact the building of generational wealth. So there's still more to say about that, but I'm very mindful about time. So I'll just go to the next point, which is about life insurance. Now, life insurance here is the overarching idea is that whatever you cannot afford to replace, you need to insure. So I know many people from our background are always very mindful. They don't want to, talk about life insurance because they think you are talking about death. While it is true that, life insurance is something that pays out when something goes wrong and you don't want something to go wrong. But the reality of it is, if your family will struggle when you are not there, then it is a good idea for you to think of having a life insurance, because in case things go wrong, they can have something to fall back on. And you can, even when you are not there, you can continue to support them because the life insurance pays out and that clears a lot of debts, clears the mortgage, and they have a mortgage-free house to live in. So there is no fear that the landlord will come and chase them out because they have not kept up with the rent. So again, it's a way of securing wealth for the sake of the future. Then the very last aspect of it is to pass on financial literacy. That is, you should be open and honest about money within the family. Now, sometimes talking about money can be very difficult in the sense that when you start talking about it, emotions can run high, but that doesn't mean that we should not talk about it. So we must find an avenue, a good place where we can start talking about money within our family, even with children, because we are talking about generational wealth, and begin to show them examples of how they can, start building wealth or what it means to save. For example, in our home, our children have they have this piggy bank. Now, even though most times the piggy bank is everywhere, and but then they know that if someone gives them money, cash, for example, then the cash goes into the piggy bank, for example. And even without that, you can open a junior ISA for them, such that as soon as you are getting paid, you are also paying a certain amount of money, investing it for them, so that by the time your children gets to 18, they have something to start life with. And that is why you see some people, they are 22, they tell you they just bought their own house, and you are wondering, how did they save that money since they just started working? It's sometimes as a result of inheritance or a family member doing the lifting for them. So we can also be that example for our own children. And the last point here is that as you go on, pass on the lesson that you have heard, to your children. Now, however difficult it might be, sometimes you just have to share the story, share your own experience. There were times that I was having a conversation with my daughter, and she was talking about bed, and I was saying, okay, you have a bed, that's nice. When I was your age, I was sleeping on the floor. It was like strange to her. What does it mean to sleep on the floor? And that was the kind of conversation that we can have to begin to show that, look, you have this privilege, you have this opportunity. This is what you can do with it. This is how you can make things work better, even for the next generation. But the idea is you must make sure that the fact that you have struggled in the past doesn't mean that your own children should struggle. You should be a pathfinder to create a higher or a better playing field for them, such that the next generation will build upon what you have built, and the next generation after that will build upon what the next generation have built. And so by so doing, we can go on and on to build generational wealth, even for the foreseeable future. And I hope that this conversation tonight has been helpful to someone. So just before we go, I want to say a few concluding remarks. One is that if it sounds too good to be true when it comes to investing, it probably isn't true. So you need to be very careful about that. Now, when it comes to investing, saving, it's good to start small. You don't need to have £10,000, £500,000. You can just invest £25 on every month, and starting small gradually can go a long way. Then try to do it consistently every month, every week. As soon as you are paid, do something, pay something into that. It might be a little bit of inconvenience, but by the time you look back, you have some money somewhere that you can fall back on without necessarily going into debt. Then as you do all these things, whether in your place of work, in your pension, begin to think about the future. Begin to think about the future. And very lastly, when you are not sure of what to do, you can always talk to someone, seek counsel, and even you can talk to a coach, you can talk to a professional financial advisor. Of course, advisors are not cheap. Sometimes they charge you 1%, sometimes they charge you £4,000 for an advice. But for many people that are just starting out, this is why we have webinars like these, and we have platforms like Equip Stewards, where we do these things for free, just to help everyone get better.